Today I wanted to talk about breaking down your paycheck. So a lot of people complain about taxes, but they don't really look at what they're actually paying for taxes. And so the more you know about what you're actually paying, the more you can work with your taxes and understand them and be less frustrated. So everybody will pay a Social Security income or Social Security tax. So whatever you get paid, so you get paid $100, uh, you will pay 6.2% of your income to the Social Security system. So if you get paid $100, you'll pay $6.20. So workers pay that percent, and their company employers also match 6.2%. Meaning, if you're self-employed, you will have to contribute 12.4% of your income to Social Security, and this does not change. So once you start taking maybe some of the recommendations I try later for changing maybe your HSA or your 401k contributions, you'll see that your Social Security does not change. Medicare, similar to Social Security, employees pay 1.45% and the employer pays 1.45%. Also does not change. So now I'm talking about some ways to reduce taxes. And so I guess the taxes here that you're reducing are your state income taxes and your federal income taxes. So some ways that you can reduce taxes are through 401k contributions, health savings account contributions, flexible savings account contributions, and donations to charity, which that doesn't get taken into account until tax time. So I probably won't talk too much about that during this slide. So your health savings account, for 2016, your health savings account, if you're an individual, the maximum is $3,350, no change from 2015, and the max for a family is $6,750, which is an increase from last year. So if you're making $50,000 and you put, so you're an individual, you put $3,350 in HSA account, you will only be taxed on $46,650. So basically, your health savings account, it takes money right off of the top of your income, puts it in an account, and your health savings account can be rolled over each year, and so you never lose that money. So in my opinion, it's really great to always contribute to your health savings account, assuming you'll need that money sometime. And your health savings account can actually also be invested. Um, I don't have any opinion on that right now. If you should keep it liquid or keep some invested, you'll have to decide that for yourself. A flexible savings account is similar to a health savings account. This also takes right off the top of your income, but this money does not roll over each year. And so if you don't use this money by the end of each year, you do lose it. And so this is kind of like an account where, hey, if you know you're going to have some medical expenses and maybe you want to contribute more to your HSA and roll that over, and you need another way to get some money out, you could use the flexible spending account. But in my opinion, you should always max your HSA before putting any money in the flexible account, since the flexible account doesn't roll over. Now we get to some fun things. So kind of experimenting with your 401k. So there are two ways you can save money. You can save money in a traditional 401k or in a Roth 401k. So the traditional 401k, the money gets put in and taken out before taxes. So you can see in this example here, your gross pay is $1,000. If you put 10% in a 401k, then your taxable income is only $900. And assuming 15% taxes, And I'm just doing a flat tax here for simplicity. So assuming 15% taxes, your deposit to your bank account will be $765. And so the way the traditional 401k works is, you see here, if you increase your percent that goes to your 401k, you see your taxable income goes down the same number. So if your 401k goes up $100, your taxable income goes down $100, and so you end up paying less taxes. And obviously, less goes to your bank account. But you see that it's not a full $100 difference here. There's only $85 difference, and 15 of the dollars that actually went in your 401k came from the taxes that you paid here. And so obviously you will pay taxes on this, your traditional 401k, when it comes out when you retire. But the idea here is that hopefully you'll be paying the same or less taxes when you're older, and hopefully the money will have grown faster than inflation. So hopefully, we're saying if your retirement account grows at 7% and inflation is only 3%, dollar now will have grown to more than the dollar's worth in the future. Another thing that I mentioned was the Roth 401k, and so here you can see I compare a traditional 401k to a Roth 401k, and maintaining the same $100 going into the 401k. So again, here you see 10% of $1,000 salary into traditional 401k reduces your taxable income by $100, and you pay 15% taxes and how much goes in your bank. For the Roth, you see you put 10% in $100 again, but you see your taxable income stays at 100 because of this being a Roth. So the advantage of the Roth is that you don't pay tax. This grows tax-free, basically. So this money has already been taxed, and it will never be taxed again. So you see you pay your taxes on the full $1,000, and so you see you end up paying more taxes, obviously. And so obviously the difference between your taxes is how much lower your how much is deposited to your bank. And another thing that you can do is you can say, hey, well, if I want to maintain the same amount of money in my bank each month, then you can change your percent of your salary that is deposited to the bank. So you can see here that you'll pay 10%. You can put $100 in, basically, in a 401k, while only being able to put $85 into a Roth, and you'll get the same taxes. You'll get the same deposit to your bank account. And so you see with the Roth, you'll pay more taxes now. But so then you look at, hey, how much, so then obviously if you compound these numbers, obviously this number will grow faster and higher, but you also end up paying taxes on this at the end. And so this is all just a balance of, hey, how much taxes do I want to pay now, and how much do I think the stuff will grow versus how much will I pay in the future. And so those are kind of the things that you can look at. So I really encourage everybody to experiment with your 401k. And it doesn't really cost you a lot. So thank you for looking at this, and hope you learned something.